One of the main arguments I see about why right now in 2025 is nothing like how it was back in 2008 regarding the housing market is because the lending situation is much improved versus back then. Because you see, back then, anybody could get a loan if you had a pulse, essentially. There was almost no underwriting standards in place. It was very loose and very easy to get a mortgage, even if you were not qualified. Well, today, that is no longer the case, supposedly, but it seems like a lot of the policies that are going into place are all aimed at rolling back a lot of the protections that were put in place after the last 2008 housing market crash. And one recent example of that is the Vantage score. When Biden was still president, his administration took steps to enable less credit-worthy borrowers to qualify for mortgages to support the housing market. But now that Trump is president, he's doing the same thing, trying to boost homeownership and boost home sales by lowering the borrowing standards. Because here's the thing, government-sponsored loans from Fannie Mae and Freddie Mac have long required that home lenders use credit scores generated by the Fair Isaac Corporation, also known as FICO. That's your FICO score, your credit score from FICO. Well, now that Bill Pulte, who is the CEO of Pulte Home Builders, is the director of the Federal Housing Finance Agency, he's a big proponent for now using the Vantage score as well as the FICO score to be able to qualify for a home loan. And this is going to change the landscape of how easy or difficult it is to receive a mortgage in the future. Right now, it's being said that the Vantage score is more inclusive than the FICO score because it incorporates rent, utility, and telecom payment histories, which is not necessarily a bad thing, but this also means that younger and lower income people who rarely borrow or use a credit card can still get good Vantage scores. Doesn't necessarily mean that they're qualified to buy a home. In fact, they're saying right now that the Vantage score could allow up to 5 million more prospective home buyers to qualify for loans right now. Check this out. There's a deer crossing the street right in front of me. Oh, there's a bunch of them. It's a family, the deer family. So cool. Now, Bill Pulte, he says that the Vantage score will boost competition and reduce closing costs for borrowers since FICO does charge a fee for its scores. But we're talking, very small reductions in closing costs here, nothing really to worry about. But one of the big risks moving forward is that lenders will rely on Vantage scores ratings to qualify marginal borrowers and make riskier loans. And one of the reasons this can be risky is because traditionally the Vantage scores are higher than FICO scores. And if lenders start relying on this more, well, then obviously that's going to shift the landscape of who's qualified and who's not. And we're already in a situation right now, actually, where mortgage delinquencies are on the rise as borrowers are being squeezed by inflation and rising homeowners insurance premiums, rising property taxes, the whole thing. So we're already seeing financial distress among current homeowners before they put this into place. Imagine what it's going to be like afterwards once it's easier for people to get a mortgage. And these people who got the mortgages were traditionally lower risk. So if the Vantage score opens up a pool of 5 million additional home buyers that are actually a higher risk, what do you think the default rate's going to be in the future? And think about it like this. During the pandemic, we had all the stimulus checks. There was a lot of payments on pause. People didn't have to pay rents. People didn't have to pay mortgages. People didn't have to pay for student loans. Well, now that all of that has been reversed, some of those borrowers got loans back then, and it seemed like it was less risky at the time because they just didn't have those payments. But now, fast forward, they have all these payments, and clearly people are struggling financially. That's why we're seeing these delinquencies shoot up. And this is especially true for student loan borrowers because TransUnion, they recently reported that 31% of federal student loan borrowers had a payment due in April that were 90 days late or more. So the delinquencies are triple what they were a few years ago. And a lot of these newly delinquent student loan borrowers have seen their credit scores drop on average 60 points. But how many of them qualified for mortgages based on previously artificially high credit scores? That's the same problem we could be looking at with the Vantage score thing. So we're already seeing problems develop in the housing market. We're already seeing home prices come down. We're already seeing borrower delinquencies go up. And somehow the current administration thinks, oh, this must be a good time to ease lending standards. You know, it's just like one bad decision after another, really, when it comes to trying to juice the economy, because that's what they're doing, right? They're trying to juice the economy and make things look good. No president or no administration ever wants things to look bad under their watch. So they do things like this that are not really very smart. They try to make things look good in the short term that makes everything worse in the long term. Kind of like the big beautiful bill. Check out this GTO. This thing is sweet. Very nice ride. And another thing that's happening is more people are being pointed towards getting an adjustable rate mortgage in this environment because mortgage rates have not come back down to where everybody was hoping that they would. You know, I just made a video the other day talking about how a lot of these homeowners that bought in the past 2 or 3 years who were betting on interest rates to come down haven't seen that reduction, and they're now paying the price because they got either a mortgage rate buy down or they bought a house they could barely afford 3 years ago, and now the mortgage payments are up, you know, $400 or $500 a month due to higher insurance premiums, due to higher property taxes, and suddenly it's unaffordable, and that promise of being able to refinance is no longer there since rates haven't really budged. Well, now more people are being pushed into trying to get one of these adjustable rate mortgages. This is the advice that a lot of lenders are giving home buyers today. And you know, the crazy thing is, guys, think about this as well. We're already in the middle of July right now. The home buying season is essentially over. You know, school starts again in like what, a month from now? Something like that. And this is pretty much when home buying season is winding down to a close. You start seeing home sales start to go down from this point forward throughout the rest of the year. And the crazy thing is, they never even really went up. So the mortgage industry obviously is getting desperate. So what are lenders telling people? You should start looking at adjustable rate mortgages. One mortgage lender here in this story says that they can offer an adjustable rate mortgage with an interest rate well below 6%. So what is well below 6%? To me, that means somewhere probably in the low fives, right? So probably like a 1.5 lower than getting a traditional 30-year mortgage right now. I can tell you right now, guys, whatever the savings is, it is not going to be worth it, at least for the vast majority of people, unless you have an exit strategy where you know you're going to be able to get out of that loan before it's time to refinance. Because with adjustable rate mortgages, the loan rate that you're getting is usually fixed for the first 5 to 7 years, and then after that, it can adjust every 6 months thereafter. And it is working on some people. Some people are taking the bait on this because according to the Mortgage Bankers Association, 7.7% of applications last week were for adjustable rate mortgages. And I just have to say, as somebody who sold homes for a living for a solid 13 years, guys, it's just never worth it. You know, I think the whole time I worked as a real estate agent, I had one client get an adjustable rate mortgage. And the reason he did it is because he knew he wasn't going to keep the house for more than 5 years. That was the plan. He already had an exit strategy. The plan was to buy the house, live in it for a few years, remodel it, turn it around for a profit. So for him, it didn't matter because he knew he wasn't going to stay living in the house. So by the time that the fixed period was over and the mortgage could adjust, he would already be out of the house. So it did work for him. And that's pretty much the kind of person it's meant to be for. You have to be savvy with these things. But if you're buying a home with an adjustable rate mortgage with the hope that you're going to be able to refinance later down the road, and your plan is to stay in the property long term, that can be a very bad move, just like people who were promised that a few years ago. If you missed that, go watch this video because it's a great example of how people kind of believe that lie and are now stuck with payments much higher than they thought they were going to be. In fact, you are always better off trying to get a lower price off of the listing when you're going to buy a home rather than jump into some kind of sketchy mortgage situation that you're not sure you're going to be able to get out of or refinance out of into the future. And here's what I mean. Ron, one of my viewers, sent me this email from a 55 and older community, at least it seems like one of those, in Ocala, Florida. And look at this headliner here. Save up to $78,000 on exclusive move-in ready homes. And then they show you this banner here of the homes that are available for sale and how much they're slashing prices here. Like, these are good, like 15% price reductions here. And some of these homes are still sitting on the market, you know, going down from 544,000 down to 465,000 and still unsold. That's quite the discount. And some of them that did sell sold for about 15% off. It's something I have said like 100 times before on this channel, but I will say it again, especially if it's the first time you're ever watching one of my videos, is you can never change the purchase price of the house. You can always change your interest rate at some point. Doesn't mean it's always going to be a favorable time to refinance, but it is possible to change it. You're not in control of how much your property taxes go up. You're not in control of your homeowner's insurance or anything like that, but you are in control of how much you pay for the property. And I think that is the most important factor that you pay attention to moving into a home purchase now and into the future. And speaking of insurance, another story that was recently sent to me was about how a lot of insurance companies are now refusing to cover properties in climate change risk zones. That's what insurance companies label some of these areas as climate change risk zones, where it's so risky that they're refusing to write coverage. And some of those are right here in California and in Florida where I live. Take a look at this. There's been a surge in non-renewals for insurance policies from 2018 to December of 2024. About 1.9 million home insurance policies were non-renewed in the United States. That's 2 million people losing homeowners insurance. And remember, you need to have homeowners insurance in order to comply with the terms of your mortgage if you have a mortgage. In fact, non-renewal rates have tripled in over 200 US counties, and California, Florida, and North Carolina are the hardest hit states out of all of them. And obviously this is because of the storms, because of wildfires, because of flooding, because of hurricanes, all of it. And the damage from these storms has been astronomical in terms of cost, mainly because of inflation and labor costs, how expensive everything has become after the pandemic. And these companies, they just don't want to pay, or they don't want to take the risk that they might have to pay. You see, take a look at this. This is what I was talking about in the solar panel video. You got solar panels on top of a shingle roof where they have to poke holes in the roof. That's exactly what professionals say not to do right there. So the government's response to this is that some states are kind of allowing insurance companies to raise premiums if they continue coverage in the high-risk areas. And that's like the trade-off in the deal that they're making, so people can still keep their insurance. But obviously your insurance rates then go through the roof. Companies like Allstate, they stopped selling new homeowners insurance and condo policies in California back in 2022, citing rising costs and weather risks. State Farm also halted new housing insurance sales in California in 2023, and about 12 insurance companies have pulled out of Florida since the beginning of 2024. So little by little, it's like some of these areas are just becoming uninsurable. And this can have real implications on the future housing market, because not being able to obtain insurance on large areas of the country leads to declining home values and lower demand. And ultimately, empty homes lower property values even further, and it reduces local tax revenue. So basically, more and more communities are at risk of being left behind if there's no action taken. But honestly, you know, people want the government to do something. All they typically do is mess things up and make things even worse for us in general. So I don't really see the solution to this, guys. Really, the only solution I think that's really going to work for most people, and it only works if you have no mortgage, is going to be self-insuring in the future. I think that's the direction things are heading, is having no mortgage and self-insuring. And having that be a problem in a lot of areas across the country is greatly going to reduce property values, because if you have to be able to have no mortgage, well, guess what? Who's going to be able to buy those properties? Only people that actually have enough cash to buy them, right? That's it. Here's a house that was listed for sale back in April for $1.4 million. Then they did a $50,000 price cut. And shortly after that, they were actually able to get the house under contract. Right now, this place is pending. It looks like these are the type of houses you really see selling around here in Marin County, are the more affordable houses. I know 1.35 million doesn't seem very affordable for a lot of areas across the country, but when median home prices around here are about $3 million, that's not a bad deal. Now, one other thing I want to bring up is this HOA nightmare story that was sent to me that I thought was kind of interesting and funny at the same time, because I've never heard of anything like this before, so I wanted to share it with you guys. There's a neighborhood in Pinellas County, Florida called Stonebriar, and this community is a community of single-family homes that is within an HOA, and they are facing an $82,000 special assessment, all because one neighbor decided to put up one of those plastic snap-together sheds in their backyard. And what happened is the neighbor put up this shed, and they were asked nicely by the HOA to remove it. He refused to remove it, and they actually put in the application with the HOA to get their permission, and they never said if it was okay or if it wasn't okay, so he ended up just putting it up anyways. Well, now because of this shed, the HOA is going through a lawsuit with this one property owner to get him to remove this shed, and the $82,000 special assessment is for all the legal fees that are being incurred by the HOA to fight this lawsuit, and everybody in this HOA has to pay. I mean, I have never heard of anything like this before, guys. If you have, let me know, but this just sounds ridiculous. And it's funny because the story that talks about this has some pointers on what you can do in order to make sure you don't get blindsided by one of these special assessments. Well, first of all, there's nothing you can do to prevent getting blindsided by a special assessment. They can just come out of nowhere, especially when things like this happen. But the first one that's kind of funny, it says budget for the unexpected. Like, as a homeowner, you got to budget for the unexpected no matter what type of property you buy. That is the reality, guys. Whether it's a property in an HOA, a condo, a regular single family home like in a neighborhood like this, you always got to budget for the unexpected, because you will get hit with the unexpected one day. In fact, you should be saving somewhere in the neighborhood of probably at least $5 grand a year, putting that towards just the unexpected fund for your property. Unexpected household expenses typically add up to being about 1% per year based on the home's value. So if you have a $300,000 house, you can expect $3,000 a year to be spent in unexpected expenses. That's a realistic number, and obviously it goes up from there. But really the best way to avoid situations like this, like a big unexpected special assessment, the God's honest truth is to just stay away from buying any property in an HOA. That's the only foolproof way, 100% guarantee, that you're never going to have to pay a special assessment. That's it. You're still going to have unexpected expenses as a homeowner, but special assessments are in addition to that. So if you never want to face a situation like this, never buy a home in an HOA community. That's basically the only thing I can really tell you that will help you. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.